Why does Warren Buffett say that diversification is only for people that don't know what they're doing? And why is he wrong? In this video, I'll show you how diversification helps you reach your investing goals and why it's essential for 99% of the investors out there. Then I'll show you a strategy to get that instant diversification plus higher returns. We're talking portfolio diversification today on Let's Talk Money. Beat debt, make money, make your money work for you. Creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, this is going to be one of my most controversial videos. I know there are a lot of Buffett fans out there and he may very well be the best investor of all time, but in this idea, he's flat out wrong. Buffett has said that diversification is only needed when you don't know what you're doing. He's also said that only stock concentration builds wealth. Hell, Mark Cuban has even gone so far as to say that diversification is for idiots. But these guys are wrong because they're looking at it from a billionaire's perspective. And I'm going to show you why everyone in the Bowtie Nation, myself included, needs diversification in our investments. So I'll start by showing you what is diversification, sharing a couple of diversification examples, then explain why Buffett has never been more wrong on something. Then I'm going to reveal a strategy that makes diversification easy and still lets you pick stocks for those market-busting returns. So diversification just means having a combination of investments so you don't lose all your money when shares of just one stock take a nosedive. It can mean holding different stocks. It means different assets like stocks, bonds, and real estate. Basically just not having all your proverbial investment eggs in one basket. For example, if you had all your money in shares of Tesla, you'd be feeling pretty good for a while with some huge returns. But then what happens when the shares go the other way? And I know everyone likes to think that they just hold on until those shares bounce back higher, but the fact is that many investors end up panic selling at exactly the wrong time. They buy in as the shares are heading higher, then sell on the way lower, making for that huge loss. By investing in different stocks, bonds, and real estate for that diversification, your portfolio doesn't rise or fall with just one investment. If we look at this chart of the Vanguard Balanced Index Fund, now that's a fund made up of 60% stocks and 40% bonds in green here, and the stock market S&P 500 index in red from 2000 to 2014, you clearly see the effect of diversification. Now that S&P 500 is already pretty well diversified across those 500 stocks, but it's still exposed to that roller coaster anytime a stock crash comes along. By just putting less than half your investments in bonds, you could have had a lot fewer sleepless nights in 2002 and 2008. Now that's not to say that you wouldn't have seen your portfolio fall at all during those periods, but that stress that causes investors to panic sell at the bottom, it just wouldn't have been as bad. You could have taken advantage of those lower stock prices to sell some of your bonds, buy into the market, and you would have made even more money. So let's look at some pros and cons of diversification. Then I'll explain why our billionaire buddies are flat out wrong. Then reveal that strategy for diversification. The pros of diversification are that you get to take advantage of whatever trends that comes along. Whether tech stocks are surging or gold is taking off, you're more likely to benefit because you have a range of investments. Now, as we've talked about, diversification also smooths out that roller coaster ride when stocks fall. You're less likely to worry about your money and less likely to make those bad investing decisions. Diversification also gives you the opportunity to rebalance your portfolio and take advantage of those lower prices. When stock prices fall, you can sell some bonds and buy into a cheaper market. When the stock market surges, you can sell some of those stocks to buy cheaper real estate or other assets. But diversification also isn't the miracle cure for making money. The downside, and this is the main point that Buffett makes, is that your total return is smoothed out by those winners and the losers. Just like you don't lose half of your money when Tesla crashes, you also don't see your portfolio double if the shares rebound. Case in point, our 2019 dividend portfolio challenge we put together in January is beating the market with a 25% return. But look at what it could be doing if we had everything in just Haynes Brands with a 154% return, or even General Mills with a 92% return so far this year. So you do sacrifice some of that potential in exchange for that smoother, less stress strategy and diversification. Now, the problem with Buffett's thinking here is that he's speaking from the perspective of a portfolio manager. Buffett has an army of analysts looking at stocks. He's got $128 billion in cash that he can jump in and out of stocks if prices fall. He can literally buy an entire company as an investment. It's a completely different kind of investing for you and me, right? Now, I'm guessing, now tell me in the comments if I'm wrong, but I'm guessing you don't have analysts digging into the financial statements all day. I'm even guessing that you don't have all day to pick out individual stocks. Even your bow tie buddy here, I don't have all day to pore over financial statements like I did back in my analyst days. I might spend 10 or 15 hours a week reading market news, picking stocks, and reading cash flow statements, but the rest of the time I'm putting together videos or blog posts or picking out ties. Now, another difference here is that Warren Buffett is cursed by his own success. His Berkshire Hathaway has produced a 13% annual return over the last 3 decades versus a return of just 7% on the market. But now investors have come to expect that. Buffett can't use diversification. He can't invest in a lot of companies and get that market return because he has to beat the market. Slip and get that market return for just a year and investors wonder what's wrong with Warren. Now, you and me, though, our problem isn't beating the market and making our investors happy. Our problem is avoiding those big mistakes. Our goal is making money when the market rises and not losing it when the stock market crashes. Now, that's how regular investors win the stock market game, and the way you do that is with diversification. You invest across different stocks, different assets, and take advantage of the benefits of diversification that we've talked about. Now that we've seen why diversification is a good thing and why Buffett can stop calling me constantly trying to argue the point, now I want to show you how to create a diversified portfolio for a stress-free investing strategy that's going to meet your goals. And when you think about creating a diversified portfolio, so a well-grounded group of investments that it's going to give you a good shot at market returns and maybe a little extra return there, you want to think in terms of 2 or 3 ways you can diversify. First here is going to be by asset class. And this means making sure you have stocks, bonds, and real estate in your portfolio. These 3 types of investments all react differently to the economy and other forces in it. So bonds are going to save your ass when stocks plunge. Real estate is going to do well when inflation wrecks your bond investments, and stocks are going to provide those oversized returns when the economy grows. Investing in stocks, bonds, and real estate is like being able to throw rock, paper, and scissors all at once. Second here, you want to make sure you invest in stocks from different sectors. Now, these are groups of companies all from a part of the economy like tech or utilities or consumer staples. Each sector responds to the economy differently and has different business characteristics. So tech stocks and financials tend to boom when the economy is doing well. Utilities and consumer staples are safer during a recession because they sell those necessary products. Now, this doesn't mean you have to invest blindly across every sector either, though. We just finished up an 11-video series picking the 5 best stocks from each sector. The idea in that is that you can get that diversification. You can get those investments across many sectors that are going to help protect you from that crazy stock market, but you can also still get that higher return by picking individual stocks. So I'll leave a link to the stock sector series in the video description below, so make sure you check that out. Another way to think about that diversification before we get to that strategy to make this all so much easier is going to be in terms of geographic diversification. This is one that is sorely missed by most investors. We have a bias towards stocks of companies based in our home country, and it's really a lost opportunity. Investing in stocks of foreign companies not only helps to smooth out your portfolio away from that domestic market crashes, but also from exchange rates and interest rate problems. For U.S. investors, getting a little foreign exposure is easy through American Depository Receipts, or ADRs. These are just stocks of foreign companies that trade on the American exchanges. So you can buy shares of Alibaba or British Petroleum just as easily as you could buy shares of Amazon or ExxonMobil. Now to that strategy to get all the diversification you need, plus the opportunity to pick stocks and make that little extra return. This is actually something we've talked about on the channel before, but it's critical to your idea of lowering your market risk and getting higher returns. The strategy is called core satellite because you have a core of investments that make up maybe 60 to 75% of your portfolio. Now, these are exchange-traded funds, ETFs, or other funds that cover a group of investments. For example, you might have 15% of your money in the Vanguard Real Estate Fund, ticker VNQ, which holds shares of companies in the real estate sector. Maybe you hold another 10% or so of your money in the Vanguard Long-Term Bond ETF, ticker BLV, which invests in hundreds of bonds and pays a 3.3% dividend. Finally, you might hold another 50% of your portfolio in a few funds like the ProShares S&P 500 Dividend Aristocrats ETF, or ticker NOBL. This one holds shares in the best dividend stocks in the market, shares of 57 companies all in one fund. So by investing most of your money, that core 60 to 75% in 3 to 5 funds, you get instant diversification across stocks, bonds, and real estate. Your money is spread out across hundreds of stocks. You've got bonds in the bond fund and cash flow from that real estate fund. Then with that satellite portion of your portfolio, the remaining 25% or so of your money, you invest in individual companies that you really think could produce those higher returns. Now, this is where you get in touch with your inner Warren Buffett for picking stocks and getting those higher returns. You follow the trends in the market, you dig into those financial statements and find those companies with a competitive advantage and that just are underappreciated shares. The beauty of this core satellite strategy, though, is that because you only have 25% of your money invested in these individual stocks, and say you invest in 3 to 5% in each stock, that means you're only picking maybe 8 to 10 individual stocks. So instead of having to find 20 or 30 or more stocks for your portfolio, doing the hours of analysis on each and keeping up to date on each one, you only need to find a handful of winners. This is going to cut in half the amount of time you spend looking for stocks to buy and following your investments. You don't have to worry about those 3 to 5 funds you hold. They're diversified across a group of stocks, bonds, and real estate, so they'll be getting that average market return in each of those assets. All you have to do here is maybe look at your portfolio once a year or so to make sure that those percentages of your money, the target percentages you set up in those funds are still about right in that core part of the portfolio. For example here, maybe you start the year with 45% of your money in the stock funds, 10% in the bond fund, and 20% in the real estate fund. After a year or two, though, maybe the stocks have taken off and you've got 55% of your money in those funds and only 7% in the bond fund and 17% in the real estate. This is where you'd go back in and rebalance that, selling some of the stock funds to buy more of those other funds, and then just bringing everything back to your target percentages. That's going to leave you a lot of time to finding those few individual stocks that you need, or just not worrying about your money. Spend maybe a couple hours a week keeping up to date with your stock picks and know that you've got that mix of diversification and the extra return with this strategy. Check out my favorite 7 dividend stocks to create passive income every single month by clicking on the video to the right. Get your portfolio started right with these cash flow investments. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.